Is this your very first time filing business taxes? If yeah, you are at the right spot, because in today's conversation, I'll be breaking down step by step, baby steps, how to file business taxes for the very, very, very first time. Don't you go anywhere. You're going to love today's conversation. I guarantee you.
One in a million, one in a million, one in a million. You know they're coming up to me, cause I'm just the kind of flower that's stinging in the beat, but the rhythm's getting higher. Go, 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 go. One in a million, one in a million, one in a million, one in.
Welcome back, folks, to another edition of the Awesome Sweetie Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as great as I am, go grab a cup of coffee, or tea, or vodka, and let's roll. In today's conversation, I want to explain to you how to file business taxes for the very first time. So here are the steps. Number one, you want to organize. So you need to organize your records before filing a small business tax return. And this is really important. So when we talk about organization, you got to have the paperwork, the right paperwork. So what are the documents you need to have at the ready? Very important. Gross receipts, checking and savings accounts interest, returns and allowances, sales records, unclassified income, so income that you cannot categorize, employee wages, insurance premiums, professional fees, contractor payments, office rents, transportation and travel expenses, advertising costs, office supplies and equipment, telephone and other communication devices. Now, this list is not exhaustive, so you probably have fewer or more expenses. The whole thing is you have to look at your business and see whatever applies to your business. The best way to do this is to go to your accounting software, whether you're using QuickBooks, Xero, Wave, Expensify, and whatnot. You choose the accounting software and you look into something called your statement of income. So you have to look at your business statement of profit and loss. It's called profit and loss statement. And basically, you go into the expense categories. You will have a list of all expenses that you have there. And you can go as granular as possible. So that this will actually help you know what kind of paperwork you need to have. Very important. Also, do not forget to separate personal and business expenses. Okay, so this can be very difficult to do if you are a sole proprietor conducting business out of your home. Nevertheless, it is essential because the IRS has very strict rules about not using your personal expenses as business deductions. For example, say you use your car for both personal and business purposes. You need to keep an accurate log of your business uses of the vehicle. The same principle applies to your finances. So to keep business spending separate from your personal finances, consider opening a separate checking account. You don't necessarily need a business account. You can have a separate personal account also if you have a sole proprietor. Okay, so first thing you want to organize, very important. Second step, you want to ascertain, what we call ascertain. In other words, you need to be clear on your tax obligations. Okay, so when submitting a tax return for your small business in the first year, knowing what IRS forms to file and what taxes you are liable for can be confusing. So it all depends, and when you really think about it, it all depends on what sort of business entity you have. Okay, some hold the owner personally responsible for company taxes, whereas others separate the business tax liabilities from the owners. Okay, and each business structure requires a different IRS form. So let's just break it down for you. So we have broken down these entities so you will not face any surprises when filing a business tax return for the very, very, very first time. Okay, let's say you are a sole proprietor. So that's the first entity. So a sole proprietor is a single owner business structure. So the owner, called the sole proprietor, is considered the same legal entity as the business. So the required IRS forms, we have income and self-employment taxes are filed with forms 1040, Schedule C, and 1040 Schedule SE, respectively. If you are a partnership, so a partnership has two or more owners. So like a sole proprietorship, a partnership is only taxed at the personal income level. What are the required forms? You have Form 1065, is actually used to report business income and expenses to the IRS. And the company sends Form 1065 Schedule K1 to each partner, showing each person's share of income and losses. So partners then use Schedule K1 to fill out their personal income tax returns. Let's talk about corporations. So a corporation's profit is taxed to the corporation when it's earned, after which it's taxed to the shareholders when distributed as dividends. That's what we call double taxation. So the required IRS form, so you have to use Form 1120 to calculate and return the business's federal income taxes and to report the corporation's income and expenses. Let's talk about LLC, so limited liability company. So a limited liability company, LLC, combines parts of corporations and partnerships. Like a corporation, an LLC and the owners are separate legal entities. So, and like a partnership, the owners have shared tax liabilities. So taxes pass through to the personal income level, so the business is not double taxed. Okay, so depending on the way an LLC is set up, the company will file as a corporation, partnership, or as part of an individual tax return. Let's break it down further. So you want to be sure to use the correct form. So if you're an LLC, remember, you can actually file as a sole proprietorship. So you need to fill out Schedule SC for your self-employment taxes and Schedule C for business profit and loss. If you are a single member LLC, like a sole proprietorship, you need to fill out Schedule C. Unlike a sole proprietorship, you do not need to fill out Schedule SC. For a corporation, you need to fill out Form 1120, the corporate tax return. If you're an S Corp, an S corporation is different from a corporation, so Form 1120S. You need to file that, and this is really different. And if you're a partnership or multi-member LLC, you need to fill out a Form 1065 for the business, and each partner members needs a completed Schedule K1. Step number 3, you need to estimate. So you need to estimate taxes. This is very important. Okay, you need to think about how to pay and when. So once you begin earning money as a small business owner, you should have started paying quarterly estimated taxes if you expected to owe the IRS $1,000 or more, and this is $500 for corporations. So sole proprietors, partners, and S corporation shareholders use Form 1040-ES that I just showed you earlier to submit estimated taxes. Corporations use Form 1120-W. So how much you should have paid in quarterly estimated small business taxes? Well, this depends, because since this is your very first year of business, the answer to this question is not straightforward because you had no point of reference. So a good rule of thumb is to set aside 30 to 40% of your income. You might be thinking that's a lot of money, and perhaps you're wondering, do small businesses get tax refunds for overpayment? Well, while putting aside at least 30% of your income could lead to slight overpayment, the IRS will give you a small business tax refund for your first year of filing if you have paid much in estimated taxes. Okay, but that's if you are a C corporation, because if you're an S corporation, an LLC, a sole proprietorship, you're getting a personal refund. Okay, so you need to plan for paying self-employment tax. This is important. So profitable sole proprietors are sometimes surprised to find that self-employment tax, meaning Social Security and Medicare tax for self-employed individuals, can be a significant part of their total tax bill. So be sure to calculate these taxes as part of your estimated taxes when paying quarterly taxes. It's very important. So be prepared for a tax day surprise. Not only is the balance due for last year's taxes, but also due is the first quarter installment for next year's taxes. So think about those things to make sure that you are monitoring your cash flows properly. Okay, and this is important. And don't be afraid to ask for help. Really, seriously, the whole thing is that filing business taxes is very different from filing individual taxes. So different rules apply, and you require different tax forms, probably in greater quantities than you have ever used before. So the tax system is not easy or intuitive for most people to understand. So if you think about it, accountants spend years learning the IRS rules and regulations to help people prepare their taxes. So take advantage of their expertise, okay? So you don't actually make costly mistakes. You can actually get a CPA, you can get a tax attorney, you can get a tax practitioner, or you can get an enrolled agent. The options are definitely yours. Step number 4, you want to write off things. This is the cool part here. Very important, okay? So you want to capture every deduction that you are legally entitled to. When I started this conversation, I was talking to you about organizing. So you want to have paperwork for your expenses. You want to look into your profit and loss statement to have a clear idea of what your expenses are, okay? And so when we talk about deduction, one of the simplest ways to reduce your income tax bill is to ensure you are claiming all the tax deductions available to your small business. Okay, and the thing here is that this is where I was just talking to you earlier. If you work with an accountant, this could actually pay it off. This could actually pay off because they know, a CPA knows, an EA knows, a tax attorney knows, so they know, and so this could potentially pay off. So with their guidance, you steer clear of suspect deductions that could draw the scrutiny of the IRS while claiming write-offs you might have missed. And the best part is your accounting fees are tax deductible. So whatever you pay to the tax practitioner, you can actually write it off. Okay. So you want to get familiar with lesser known small business tax deductions. So here are some of the lesser known deductions, okay, that as a new business, you absolutely want to take advantage of. So home office deduction. So as a new business owner, there is a good chance that you operate out of a home office. In fact, a lot of startups or startup founders start at home. Okay, so if you have a dedicated home office that you regularly use only for your business and your home office is your principal place of business, you are eligible to deduct a portion of your home related expenses. Okay, and so this could be mortgage interest, homeowners insurance, repairs, utilities, and depreciation. Alternatively, you could use the simplified method to calculate this deduction, and you would be able to deduct $5 per square foot for a business use of your home up to $1,500. Also think about your startup cost. So starting a new business venture is very costly. But certain tax advantages can help you offset this financial burden. Okay, so you have things like advertisements, salary and wages for employees and instructors involving training. You have costs associated with market analysis. You have travel expenses incurred while securing customers, suppliers, distributors, or lenders. So those things could be written off very, very legally. They're not a problem. Okay. Let me just dig a little more, because here we are speaking about very interesting things. I really want you to make sure that you actually maximize your deductions, okay? So I want you to really understand startup expense deductions. So many small business deductions apply every time you file small business taxes. However, there are special first-time small business tax deductions that you can only use in the very first year. So this involves what we call startup expenses, or the money that you spend to get going before opening your business. Remember, before opening your business. So deductible startup expenses may include investigating how to create a small business, a successful business, accounting, legal fees, licenses and permits, advertising your business opening, training employees, equipment purchase or rental. Okay, as always, restrictions and guidelines apply. So during the first year you are in business, you can deduct up to $5,000 of your startup cost. If your startup costs exceed this, you can deduct the remainder over the next 15 years, dividing the amount equally per year. That's what we call about, you need to actually capitalize those expenses, those startup expenses, and then you amortize them over 15 years. Okay, so basically, if let's say you spend $70,000 overall in terms of startup cost, you need to actually treat this as an intangible asset. That's what we call in accounting, intangible asset, and you amortize that amount. In other words, quote unquote, you depreciate. You take a little bit every year, okay, for tax purposes. And also you have to think about interest payments. If you have a small business loan or are making payments against the business line of credit, you might be surprised to learn that the interest paid is often a deductible business expense. Okay, and also think about, so the bottom line is what? The bottom line is you need to take advantage of anything that can help you. Take advantage of deductions. Okay, it is to your advantage to minimize your taxable income. So doing so lowers your tax penalty and puts more money back into your business. Okay, However, there are right and wrong ways to do this. So illegal activities like tax evasion and fraud are obviously the wrong ways, definitely the wrong ways. So the right ways include taking advantages of the many tax deductions available to small business owners. Okay, so we are speaking here about banking fees, software purchases, cost of advertising, business asset depreciation, mileage deduction, health insurance, self-employment tax, and so on and so forth. Like I said, if you want to have a long list, we actually have covered this on another show, all the business deductions that you need. So please go and check out that show, or even drop us a comment and we'll just certainly answer you so that you know exactly what to do. I'll be right back right after this. Don't go anywhere.
Finest, yo, 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 Mr. Killer, and call me señorita. I pop it, got me dreaming. My legs up on the ceiling. Oh, yeah, yeah, yeah. I know when he come, he ain't never gonna leave. No. Hit it the night run, and that's the way I wanna be. So don't think I'm the one to won't ever be enough.
Welcome back, folks, to another edition of the Awesome Sweaty Kiwi Show. We are still exploring the best way to file business taxes for the very first time. And next thing you need to do, you need to choose. So when we talk about choosing, we are speaking here about choosing an accounting basis. You're probably thinking, what is that? Well, one decision that you must make is whether to prepare your tax returns on a cash or accrual basis. Okay. Now, just want to quickly say that in the United States, the tax method that is compliant with U.S. GAAP. U.S. GAAP stands for United States Generally Accepted Accounting Principles. So the one that is compliant is the accrual method. So you have two methods. You have the cash method and you have the accrual method. So under the cash basis or cash method, income is recognized when collected and expenses are recognized when paid. Under the accrual method or accrual basis, income is recognized when earned and expenses are recognized when incurred. Okay, this is not a course on Accounting 101, so I'm not going to go in detail here, but if you need help, if you just want us to dig a little further for you to go granular, please send us just a comment below. So while lenders will generally prefer to see accrual basis financial statements, tax returns can still be prepared on the cash basis, even if the financial statements are prepared on the accrual basis. So a new business might have more unpaid expenses than uncollected income at year end, and therefore might consider taking those additional net expenses as a deduction. This will be done by selecting the accrual basis. However, in later years, when the business is profitable, receivables should be greater than payables, and so the business will be recording additional net income and paying more taxes if it had selected the accrual basis of instead of the cash basis. So remember, once you make the decision as to which basis to use, you will likely stay with it throughout the life of your business, although changes are permitted. In our view, it's just better to go with the accrual basis from the get-go. Okay, certain businesses, including those with larger revenues or inventory, must choose the accrual basis. So besides the accounting basis that you need to choose, you also need to choose a depreciation method. Okay, and so the Internal Revenue Service permits a first-year deduction up to $1,040,000 in this year for most furniture and equipment, instead of writing off the cost over 5 or 7 years. So most business owners will generally elect to take the first year write-off. Okay. However, businesses without profits cannot deduct the first year depreciation deduction, although they can carry the deduction forward to profitable years. Okay, this is really important. The next step is you need to plan. So planning is very important. Okay, and again, I want you to remember that your home office deduction is deductible. Okay, you can write it off, not a problem. So when we talk about planning, we are speaking about having a system in place where at year end you are ready to go. You are definitely ready to go. You have your expenses taken care of. You have your expenses sorted out. You have your paperwork sorted out. You have the professionals who are going to help you. You have already contacted them. They're ready to go. So you got to have a system. But remember those home offices, okay? Remember also, one thing I want to say here is don't forget non-employee compensation, NEC. There's something called 1099 NEC that you need to actually issue to those non-employee non-employees. Okay, let's say you have lawyers, you have accountants, you have professionals that you work with, and that you pay more than $1,000, and you need to report their earnings to the IRS. It's just a way for the IRS to keep track of everybody's income. So you have to send this to the IRS so that the IRS can know, okay, this person got paid, and see if they are going to report those income on their personal 1040s. Okay, and also one thing that's very important also is you need to keep track of automobile expenses. Okay, because automobile expenses can be a major part for a new or existing business. So the business owner should maintain an auto log to keep track of where and when travel occurred, who was seen, whether there was a business purpose to the trip. Those things are important because if you ever get audited, God forbid, if you get audited by the IRS, they will want to see those things, and you just want to be sure that you actually are prepared. Okay, and you also have to think about the actual vehicle expenses, things like gas and oil, maintenance and repairs, tires, registration fees and taxes, licenses, vehicle loan interest, insurance, rental or lease payments. So this is a constellation of expenses that you can actually think about. Now, the IRS allows you to either have a standard mileage rate that, or you can actually deduct the actual vehicle expenses. If you go for option number 2, in other words, the actual vehicle expenses, make sure that you have the right paperwork, you have the receipts, you have you need to have paperwork, you need to have proof, you need to have the receipt if you want to go for actual vehicle expenses. Very important. So here is a recap of today's conversation. So to file business taxes for the very first time, you need to organize, you need to ascertain, you need to estimate your taxes, you need to write things off, you need to choose, either whatever the cash method or accrual method. You need to choose the depreciation method you need, and you need to plan. Thank you so much for your attention. I really appreciate it. God bless you. I'll see you next time, but until then, remember, stay marvelous.